Many people ask me directly in StrategyOasis community or commenting on videos on StrategyOasis channel, telling me why you keep saying the S&P 500 is a mean reverting index, and how would you know this will keep going? This is an extremely important subject, and in fact, I have a full dedicated lesson in my Algo Trading Masterclass only about this subject, which is developing a strategy that matches the style of the instrument. Really, this is one of the biggest reasons that switched me from losing trader to profitable trader, which is developing long separately than short and developing with a strategy style that matches the instrument instead of just blindly trying any strategy on any instrument. First of all, the S&P 500 is the most liquid, most popular index in the world. It consists of 500 companies in the US, and they are ranked by weight, so it's a system. Mean reversion strategies are a style of strategy that suggests the price, once it's diverged from the mean, it will come back to it. So when the price is, let's say, at a 200-day moving average, and when it goes too far above 200-day moving average, we expect it to go back to the moving average. Now, this works on every way you measure the mean. This could be standard deviation, could be Keltner channels, it could be an oscillator, or even it could be a simple price pullback. Okay, I have hundreds of strategies on the channel. They're all mean reverting. Mostly they are traded on the S&P 500. So we all know this. I am very pro mean reversion strategies, and I love the S&P 500, and you can develop hundreds of strategies. Even though they're all mean reversion, they will be different. But today we are just understanding why this thing work on this instrument. So in order to get enough data, I loaded here the SPX. The SPX is the S&P 500 cash index. The reason is because we can go back to 1960. Because the SPY ETF goes back to about 1993, so there is limited amount of data, and here we can go back further. And you can see here I have data since 1960, and here we have only the close until later on where we have the full patterns. And the strategy is applied, which is the RSI 2 below 25 we buy, then we exit the next day. With the RSI 2 below 25, we will get many signals, so that's why we can statistically find out if what we are saying is true or not. Now, because this is the SPX index, this is like stocks, so the price will be in dollars and cents. And therefore, if you try to test this, you will find a problem. So here, for example, I'm trading 100 shares in every trade. So if you pull the strategy is profitable, but that doesn't mean anything. Let's look at the list of trades. See, this is the first trade, 1962. The price was 70 and 100 shares in and out. We lost $98. We made $3, made 41, lost 75. You can see everything is lower than 100. But then if I forward all the way to this date, and I'm still trading 100 shares, but now the profit and loss are in thousands of dollars. So that creates a problem, because most likely the strategy is profitable just because the last 5 years maybe it made a lot of money, and it was losing money all previous years. In order to find the real edge in the mean reversion system on this instrument, we need to find the percent return, because the percent return, we can always compare it on the same instrument and on other instruments. So I imported the results here, which are the return in percentage. So these are the same trades, the RSI 2 below 25, we buy, we exit next day. So we are holding one bar, and this is the percent return since 1960. Now, if we do a pivot table on this, we can find all the results collated by year. So this is the S&P 500 mean reversion. This is the RSI 2 below 25, we buy, we exit next day. This is a 1 day percent return. This is the total accumulated every year. There is a clear pattern that's happening here. This is long only, and we can see since 1960 all the way to 1983, all the years using this strategy are losing years, except 1963. And even then, the profit is very small, but we can see the losses are big. What does this say? This say that every time the S&P 500 RSI 2 goes below 25, if we buy, we lose. But think about this. If we sell short, then we make money. What does that say? That says the S&P 500 since 1960 up to 1983, it was a breakout instrument. That means when the RSI 2 pulls below 25, if we take the breakout, which is the sell short, the next day we make money. Then something happened. Between 83 and 1994, the behavior started to change. So up, down, up, down, up, down, up, down. And then from 95 and onward, it was obviously a mean reverting instrument. So since 1995, we had 3 down years using the RSI one-day holding. So that's 28 years where the RSI 2 below 25 buy makes money holding it one day. We also notice another pattern. So let me show you here. You can see that the mean reversion strategy itself is mean reverting. So let me show you. That means the strategy itself peaks and goes back to the mean. Peaks and goes back to the mean. Peaks, go back. Peaks and go back. And in fact now, as I'm recording this in 2024, I expect either that the year will do nothing or lose money, and then we start to peak and go back for the next 5 years. So most probably, usually this happens in the first year or the second year. So 25 or 26, theoretically, based on this pattern, should be a great year for mean reversion systems on the S&P 500. But overall, I expect this pattern to continue. This expectation now is based on Perry Kaufman. I consider Perry Kaufman one of my mentors, and he mentioned to me this in an interview on this channel. He also mentioned it in his books. Usually, more participants coming to an instrument create a mean reversion effect because more traders, they have collectively different opinions, and they push it either one way and it has to go back to the mean, or they push it the other way and it has to go back to the mean. And the less participant in the market usually produce a trend following effect. Now, another pattern I collected is the 5-day return. So same thing, it's the same strategy, the RSI 2 below 25 we buy, but now we are holding for 5 days. Obviously, when we hold more, we expect to make more money. And this is the result of holding the S&P 500 for 5 days when the RSI 2 goes below 25. Now we notice a different pattern. The switch happened a lot earlier. So remember before in one-day pattern, the switch happened around 1983 till 1994. And then in 1995, we stayed in this mean reversion. But now we notice that since 1975 until 1982, that's when we saw the behavior switches. And then since 1983, we are in mean reversion. So since 1983, holding for more than one day usually makes the mean reversion strategy very profitable. And in fact, since then, we had only 5 years that are losing years and the rest are profitable. And I can still see the effect of mean reversion on the mean reversion strategy. So you can see here we are peaking and down, peaking and down, peaking and down, peaking and down, peaking. So it's 5 cycles in the 5-day strategy. But again, it looks like we are at the bottom now and we are going to pick up next year and the year after. And that is what separates algo traders from your junk YouTube traders, because we are backing everything with numbers, statistical numbers. Meaning what? Meaning I have to have a lot of data to come up with a good conclusion. But just blindly saying, wait for the price to pull back to the whatever and then do 3-to-1, all that is basically BS to me and to all algo traders. As an algo trader, you're just looking at numbers. You don't care about the instrument, the underlying, the technical analysis, just data. You apply your methodology, put your filters on. If it works, good. Do you have enough numbers to back it up? Excellent. Build a portfolio, trade profitably. So you need to take action to become a profitable trader. And the action step, meaning you need to learn how to develop a robust, successful trading strategy. To learn more, watch this video and I will see you there.